Welcome back, traders. Hope everyone is good and had a fantastic Saturday. I want to keep this video short, so I'm going to jump straight to the point. Today we will be discussing 10 candlestick patterns every trader should know. So candlesticks tells us a story, and it shows us in which direction the market will potentially go and where we'll get reversals and consolidation areas. So let's jump straight into the video. At number 1 we have the morning or the evening star. Now this candlestick patterns occur at the end of an upwards or downwards trend, and it indicates a reversal pattern. Now as you can see in this image, the first candlestick is in the direction of a downtrend, followed by a bearish candle with a small body, and the third candlestick is a reversal. So ideally closing past halfway point of the first candle. So the green candle is closing above the halfway point of the red candle. Now trading this candlestick pattern will require confirmation candle in the direction of the respective reversal. So that is your morning and your evening star. So that's your morning star, evening star, the exact same, just the opposite. Okay, we will be moving over to our bullish and bearish engulfings. Now a bullish or bearish engulfing candlestick pattern may indicate a reversal pattern. So most of these candlestick patterns that we'll be looking at today will indicate reversals in the market. Now a bearish engulfing candlestick formation shows that the bears outweighs the bulls, and in this image being displayed right now you can see that the green body, sorry, the base, the red body covers the green body completely. It engulfs that candle, and that is why we call it the bullish or the bearish engulfing. Same for the bullish, the green candlestick will cover the entire red stick, the previous candlestick. Let's move on to number 3, the doji. Now the doji candlestick is an indecision candle. So we associate this with indecision. When you see the doji, we know, right, this is indecision in the market. So this could potentially mean a reversal of the current trend or a consolidation. Now this candlestick, this pattern can occur at the top of an uptrend, at the bottom of a downtrend, or in the middle of the trend. Now as you can see in the image, the candlestick itself has an extremely small body centered between a long upper and lower wick. Okay, we're going to move on to number 4, which is the hammer. Now the hammer is viewed as a bullish reversal, usually occurring at the bottom of a downtrend. Now this candle formation includes a small body where you can see the open, the high, the low, and the close are roughly the same. Now there is a long lower wick. You can see that at the bottom of the candle, the long lower wick beneath the body, which should be more than twice the length of the candle of the body. Now the body may be bullish or bearish, which means it may be red or green. However, if it is green, it's considered more favorable in order for you to take the reversal. Okay, next we're going to move over to number 5, which is the bearish and the bullish Harami. Now a bullish or bearish Harami pattern also indicates reversal. Now if you have a look, you can see that the second candle in the pattern must be contained within the body of the first candle. Okay, now you can see it in the image, but this shows that the bullish is going, the bearish trend that we're currently in is going to turn into a bullish trend. So the middle candle needs to cover the body of the first candle, and we need to have a red candle as indication showing that we are going to have a trend reversal. Okay, the next one, number 6, we'll be moving over is called a dark cloud cover. Now the dark cloud cover pattern is seen as a bearish reversal. Now this candlestick pattern must occur during an uptrend, as you can see in the image. The bullish candle is followed by a bearish candle, so the green candle, and then we have the red candle. Now the bearish candle, there must be certain criteria to meet it in order for us to say that it's a dark cloud cover pattern. Now the opening price must be higher than the previous day's close, okay, and the closing price must close below the midpoint of the previous bullish candle. Okay, that is your dark cloud cover pattern. Now it looks similar to a bearish engulfing pattern. Just the difference between the two relates that the second candlestick, the bearish engulfing pattern, has a second candlestick opening above the close of the first, whilst the dark cloud cover opens above the high of the first candle and closes below the midpoint of the first candlestick body. So there is a difference between the two. Okay, number 7 that we will be moving over to is called the piercing pattern. Now, the piercing pattern is viewed as a bullish candlestick reversal pattern. And at the end of a downtrend or during a pullback within an uptrend or at the support, there are two components of the piercing pattern formation. We have the bearish candle and we have the bullish candle. Now, as the piercing pattern occurs when a bullish candle, which is the second candle, closes above the middle of the bearish candle, which is the first candle in a downtrend market. Now, the open price of the second candle should gap down at the market open and ensure by closing above the midpoint of the previous candle. So you can see that the green candle closed above the midpoint, the middle of the bearish candle. Okay, and that is what we call the dark cloud cover pattern. Now we'll be moving on to number 8, which is the inside bars. So the inside bar pattern is utilized in trending markets whereby the high and the low of the inside bar is within the parameters of the previous candle. So you can see in this illustration, the high and the low is in the body, the green. The high of the green and the low of the green is in the body of the previous candle, which is the red candle. Now that is what we normally call a inside bar. It's inside of the previous candle. And if the market is in a downtrend, you would look to continue in your sell, in your short position. If you find an inside bar, it just shows continuation of the current trend that you are in. Now, number 9, we will be moving over to long wicks. Now, long wicks candlestick pattern is often indicated for a trend reversal. Okay. Now, the long wicks occur when price is tested and then rejected. Now, the long wick itself indicates that it rejected the price. Now, identifying the trend is important so that you can interpret the significance of the long wick. And when you identify key levels, and price action is often used in conjunction with long wicks, because when you identify the key levels, you will identify your support and your resistance zones. And when you see the long wick rejecting off those zones, you will see that it's a potential sign for trend reversal. Last but not least, we're moving over to the shooting star. So a shooting star is a bearish candle with a long upper wick. There is little or no lower wick and a small body that's near the day's low. Okay, now it comes after an uptrend and potentially it indicates a trend reversal to the downside. Now in this instance, you will see that the distance between the high and the opening price of the candle must be more than twice as large as the shooting star's body. Now the distance between the lowest price for the day and the closing price must be very, very small or non-existent at all. So that's it all for today, guys. Don't want to make the video very long. It's just the 10 candlestick patterns that every trader should know. You can watch this video over and over till you understand it. This is something that you need to know when you want to take a trade and see the reversal patterns in the market, the consolidation patterns, the wick rejections. That's all for today, guys. Thanks for watching. Don't forget to like and subscribe and click on the notification bell so that you can be notified when the next video will be uploaded. Also, comment down below on any topics that you would like me to cover if you are a new trader or an old trader and you still don't understand certain things within the forex market.